Hi folks, if you are interested in building quant models, then this could be a good starting point. I'll be talking about some of the do's and don'ts of quant model and also some of the tricks of the trade. I'm Danish and I build quant model for WealthEasy.ai. Before you even start building a quant model, you have to answer three questions. The first question that you have to answer is the reward, which means that if you are right, how much money will I make? So if you have a hypothesis in place, which means that you think that some kind of volume analysis, MACD, ADX, or some kind of technical analysis can give a good setup. If it's a good setup, then how much money will you make if that setup is good? The first question you have to answer. The second question is the risk, which means that if you are wrong, then how much will you lose in that trade? So basically you can loosely call this a stop loss. And the third is the slippage. How much is the slippage? So if you are dealing with a very illiquid instrument, then you can have a very high slippage and versus something which is highly traded where slippage is low. Slippage is something which you lose no matter whether the trade is profitable or not, which means that when you buy something, you end up buying at a slightly higher price than what you see as a ticker. These are the three questions that you have to first answer before you even start. And how does this apply mathematically is something that we'll now talk about. Let's take example one, where my reward is 3%, which means that you are right, your setup is good, and you make 3% and on average 3% on a trade. And your risk is minus 2%, which means that your setup goes wrong and you lose minus 2% in that trade. And there is a slippage of 0.1%. I'm just assuming that you can have a different slippage based on different instruments, which means that no matter what your trade is, you will lose 0.1% in each trade. And your reward risk ratio in this case is 3% by 2%, which is 1.5. Now, I'm assuming that you take 100 trades and we'll simulate that 100 trades. So I'm assuming 30% accuracy, just 30% accuracy. In that case, what's happening is for 30% of the trades, you're making 3%. And for the rest 70%, you're losing 2%. And for all the trades, all the 100 trades, there is a slippage factor of 0.1% that you lose. So 90 minus 140 minus 10 of the slippage makes it minus 60%. That is minus 0.6% per trade if you are 30% accuracy. And as your accuracy starts to go up, for example, when it's 40%, you make minus 10%. Same math, you can do that. And with 50% accuracy, you end up making 30%. So you start to make money once you are 50% accurate and your gain is around 30%, which means on an average 0.3% per trade. And with 60% accuracy, it goes up to 90%, which is close to 0.9% per trade. I'm not going beyond 60%. I'll give you some basic understanding of quant model. When you're building quant model, it's very difficult to achieve an accuracy of say 60, 65, 70, 75%. I'll give an example of a medallion fund. Medallion fund is by far the most successful hedge fund in the history of capital markets, and their accuracy was around 53%. So you should basically assume that no matter how good your quant is, ability to go beyond 50, 55, 58% is very, very difficult. And you have also to prepare for the worst situations when everything goes wrong. The second example is where your reward is 3 and your risk is minus 1.5%, which means that your reward risk ratio is 2. So we are moving from 1.5 to 2. Let's see how it works. So with 30% accuracy, you are minus 10%, which makes it 0.1% per trade. Why I'm sticking to 30% is something that I will talk about later. And as your accuracy increases from 30 to 40%, you start to make money. So look at this beautiful thing. It's just with an accuracy of 40%, you are profitable. You are profitable, slightly profitable with a 0.2% per trade, but you are profitable, which means that you are less than 50% accurate, but still you are making money. And with 50%, you are more profitable at 0.65% per trade, and at 60%, you are 1.1% per trade. When you are building quant model, one of the most key metrics that you have to look for is the gain per trade. This absolute value doesn't make much sense. What makes higher sense is this value. Higher this number, the better chances you have of making money. Let's take the third example where our reward risk ratio is 3, which means that average gain is 3% and average loss is minus 1%. Here at just 30% accuracy, you are profitable, which means that your gain is 10%. You are making 0.1% per trade, which means that Much below 50%, at 30% accuracy, you are profitable. At 40%, it goes to 0.5% per trade. At 50, it goes to 0.9, and 60, it goes to 1.3%. You can do that math yourself. Now let's look at this table. Now I'm having my risk reward ratio of 1.5. I start to break even somewhere here between 40 and 50%. My risk reward ratio is 2. I start to break even between 30 to 40%. My risk reward ratio is 3. I start to break in at 30% or below. Now, why is this important? Is the point of 30% and the reward risk ratio that you have. Now, be prepared that at least 2 months in a year, your accuracy will be horrible, as low as 30% or even lower. So you have to be prepared for that situation. So the starting point has to be deciding what your risk reward ratio will be. Unless you do this, you will not be profitable in the long run. So if you have a fantastic setup which is accurate maybe 85% of the time, but when you lose very big, then even with 85% accuracy, you may not be profitable. And you can do that math yourself. And finally, if you have a very high reward risk ratio, math will be on your side, which means that even during randomness, because of just small 30% ratio, just because of the randomness, you will end up making money. And if your quant model is good, then you will end up making even higher money. So that aspect of math is very critical. I'll leave you with few resources. You should read the book The Man Who Solved the Market. It's a great book to understand how you can take a hypothesis and convert that into a profitable quant model. You can also follow us at WealthEasy.ai and start your free trial to understand how we use AI to build low risk model for retail investors. In the next session, I will talk about different type of quant models. So thanks a lot, folks, for watching. If you have any doubt, specific question, then please feel free to write that in the comment section. Thanks for watching.